All right, great. I think we're live. We're live with the Mortgage Podcast. The genesis of this show was Bob. You called me a few months ago to say you wanted to have a show really hosted by CMBs to interview CMBs on some of the most pressing issues affecting the mortgage business, at large, and to certainly encourage others who view the show to consider the CMB path as we have and have done. So today's victim of our show is the very well-known Deb Jones. Deb, welcome to the show.
Thanks. I'm really excited to be here. Thank you. I know we had some scheduling challenges, but you guilted me into finding some time sooner than later, and I'm glad we're doing it.
Yeah, I'm really glad. We don't know each other all that well, and so when Bob had suggested you for the show, I was super excited, to have you on it. And you're actually our first capital markets leader that we've had, unless you want to consider Nolan Turner maybe a capital markets, but he's kind of an everything knowledge expert.
Yeah.
But we had talked quite a bit about servicing and some of the challenges affecting the FHA and the Ginnie Mae pools, right now. In like such a crazy, in such a crazy environment, the administration uses uncertainty as kind of a diplomatic negotiating tool, both legislatively as well as, in foreign relations. The problem is in the markets and our jobs, we don't necessarily like uncertainty,
Correct.
And so how have you, as a capital markets leader, how have you navigated these markets? How have you navigated, how do you hedge a pipeline and forecast anticipated gains when we're on such sort of uncharted, non-normal, non-linear sort of times?
That is the best question, because when the Iran war kicked off, so to speak, we were exchanging emails saying, hey, typically in a war situation, rates fall. But this is an energy crisis where inflation will be exacerbated. So we may have an opposite impact than maybe another type of war where energy is not behind it. So, lessons learned help you, but you can't operate this is the way that there's a playbook. There's never a 100% replicant of a playbook. There's always a nuanced difference. So if you think that way, you're going to catch things faster and not pull triggers on old playbooks 100%. So, the way we've evolved in the industry with more data, more analytics, that certainly has helped. We've expanded in our capital markets department the last 4 years significantly in that. And it has made a huge difference in automating processes. And we're not even fully at AI. And, if you can get out of your own way with getting data faster, you can make more nimble decisions when there's volatility and uncertainty. The other thing politically I noticed is once you know your new political landscape, whomever it is, Biden, Trump, XYZ, you learn their cadences, and the market does too, right? So the market would just do this wow reaction at first to tariffs, and then everything that came out, it's swinging. There's the uncertainty. There's the volatility. Well, I think then we all learned that sometimes his strategy is to put a big, not bomb, but a big splash out there. And now the market's a little less reactive to it because they know sometimes it's really just trying to get attention. So those are things, how do you navigate? You have to learn the new nuance in the marketplace. And that's a little bit of art, and get your science really efficient so that your data can tell you trending shifts and stories.
Interesting. I'd love to dive deeper into that, but I don't want to throw it off into.
No, I don't care. Whatever.
Trick.
Rick's already taken it. He's looked forward to this since I mentioned having you on, and he completely said to go through, the intros. Deb, tell us a little bit about who you are, what you do.
Yeah.
I know who you are. We've had the opportunity to work together for the last 3-4 years with CMB leadership and other things to the MBA, but everybody in our audience may not know. So give us a little background of what you do and who you are.
Sure, and that'll give Rick more time to find a good juicy question again. So, I mean, I've been in the business 43 years, and I like to say I'm only 39. I probably need to come clean and say I'm only, 49. But anyway, I have background most strongly and consistently in capital markets, but I have done most of mortgage banking in one way, shape, or form. I also worked on Wall Street for a period. I worked for the Resolution Trust Corporation in the 90s through the S&L crisis, which was really fascinating. I've had my own company for a number of years with another gentleman, kind of sold out that. He's still doing his thing today. And I came back to mainstream banking because I really loved capital markets so much. But at Charter One, I was for a period of time and early in Citizens as chief administrative officer. So I had originations and underwriting in addition to capital markets. So, that's helped me. But in the MBA, I got more engaged when I got my CMB in 2011. And found in the most recent years a real penchant for policy advocacy to help our industry be better. You talk about uncertainty and volatility, forget rates. Let's talk about regulation. Let's talk about policies. Let's talk about operating procedures. That's gotten harder than interest rate risk management, and I kid you not. So, I've enjoyed doing that, and that just kind of naturally led. I ended up on the MBA secondary committee as chair, and that, gets you a seat during that on ResBog. But then I came back to ResBog after that and on the MBA board, and enjoying my CMB journey as chair and working with Bob along the way. And I'm passionate about giving back education, and I'm also on the board of Capital W Collective, which was formed a couple years ago to provide education in the space of capital markets in a different and deeper way. So that's enough rambling about me. I'm into horses, live on a small horse farm in Central Virginia, and I used to own a vodka company, and that's a whole nother podcast.
I was going to say that sounds way more fun.
Definitely.
Does vodka have a capital market? It's like a secondary market?
Kind of.
What is interesting about your career, Deb, is just that intersection between, you're a hardcore practitioner, right? Like you said, like from kind of a nuts and bolts Wall Street professional up to, managing hedging and overseeing trades and capital market sort of, considerations, within, have you worked for a non-depository or is it primarily Citizens Bank? I know you've been with Citizens for like 20 something years, right?
Yeah, I've been with Citizens 20 years, but I've had 13 bosses. So it feels like 13 different companies, but it's been a great journey to take this company forward because it's been nothing but a great upward trajectory as a bank. But no, I haven't worked for an IMB. However, I've been with subs of mortgage companies back in the day that were very disconnected to the bank. So it had a true mortgage banker feel versus today's experience at Citizens is a very bank feel, but it's a good feel. So
are banks
here
back?
IMB. Yeah. Banks are back. Not all the way. And that's where I've been really advocating on Basel for 250 risk weight to come down. Yes. Because I think banks, if you think about pre-COVID, if you look at Dr. Fratantoni's data, and when we went to visit, the regulators in December, we showed the chart where the IMBs were not dominant. Now they are. So MSR investment is one, nugget, certainly there. But banks also are coming back a little bit too, because the deepening of the relationship has always been a mantra, but it's deep, no pun intended. It's a deeper goal to cross-sell products at a bank for a total bank return. And so sometimes, I'm not going to say you're a lost leader, is mortgage, but it is the biggest asset most people will have. And it really is an anchor, in a good way, anchor to other products for banks. So I think, yes, I think it is coming back. It'll come back more later if we do get some relief.
You've really seen that pendulum swing, between like heavy non-depository, pre-08 to a full-on transition to stabilize the mortgage market in the really the oversight of state chartered FDIC institutions. And then slowly we saw the non-banking channels sort of, garner its footing. And it's really fascinating, the culture within banks and how different it really is. I've done some consulting for banks, and it's interesting to me how, I've had bank presidents say to me, Rick, I'd rather do airplane loans than mortgages, because of the complexity and of course, right. We all want to lend to the A paper of the A paper of the A paper. But the reality is, I don't know. I mean, when it comes to, our charter as mortgage professionals, with the ideal and the expectation of trying to put consumers into homes, not just as a profit-driven business, but one that actually has a broader sociological kind of impact on culture and society, moving people from renting to owning homes. It seems to me that there is sort of an obligation on lenders, both non-depository and depository alike, to do mortgages to all consumers and to really open that net up. But I just don't see it in banks for the most part. I mean, there's still banking exceptions, but
yeah, I think it's there more than, I don't know. It's how, like, I think the IMBs, with no disrespect, is like a manufacturing process for profitability, and that they are not. I mean, I know many companies that are passionate about home ownership and affordability, and so I don't mean that in a disparaging way, but from an operating model, what you do get from banks is, because they're super customer experience oriented, and even the CRA and community obligations, what I think is so great, not to just tout Citizens, but some other banks that are very passionate about this too. I think about Jay Plum over at Fifth Third and how he's really evolved that company so beautifully. That when I'm here as a colleague and a stockholder, like, I get that really great feeling in my stomach about the legitimacy at this company, and I'm, high enough up the chain to see the real stuff, that their community investment is real, the passion is real, the colleague engagement is real, and I think that's why people like me have stayed here, because I would have never said I'd stay 20 years at any place, and not that I'm a job hopper, but there is that social aspect. I agree. And banks have their place, but I think that regulatory rules are governing where do we reinvest our capital. And one of the things I love about my job here is not only is it running mortgage capital markets, the MSR and the hedging and the products and investor relations, but we do balance sheet optimization with our treasury partners. We do incorporate, we're doing analytics on, do we do a back book sale now for some of the loans that are in the money to get some relief off the balance sheet, or do we do a Ginnie Mae co-issue or not? Those things have a macroeconomic view of how the bank looks across its product suite and optimizes capital and returns, risk reward. So that's a fun part of it. And I digressed from the community piece and lending, but they do feed back into, I want to invest in mortgage more because I have a high success rate of getting private bank clients into my bank. So, or CRA, because we are very community oriented at our company, and we have to be anyway. But then we want to be the best. So I don't want a satisfactory rating in CRA. I want an outstanding rating in CRA. So.
Yeah.
Well, that I think that is a cultural priority. And because you share that, especially in capital markets, since you share that, then that trickles down, both in the products, the training, the deployment, the training of the loan officers, the commitments you're making to investors. I mean, that's truly like illustrated leadership from the top down in like you said it in the most perfect way. I love it. Sorry to interrupt, Bob.
No, it's fine. No, I have a couple of follow-ups to stuff you've talked about. So, Deb, tell me, let's take back a little bit for you. When did you get the advocacy bug? Was it when you had the opportunity to step up into leadership with MBA committees and that, or was there some other time in there in your production career when you wanted to advocate for the industry, legislatively, policy-wise, regulatory-wise, whatever?
Yeah, it was when I was, just a participant on the secondary marketing committee, and real issues were starting to come up after the great financial crisis that, were really impacting how we were going to do business, liquidity. I remember going through Reg AB and Reg AB 2 coming up, and, hearing about, well, we're going to create a working group, right? Things were easier before, so you didn't have as many working groups, sub-working groups of committees. So I was like, oh, I have a real interest in this, and I have the experience, and I'm going to learn, right? So I'm always learning. Every day I wake up, I learn something new. I love when I'm wrong to say, oh, that's great. I have a new perspective, and show humility so other people will speak up and not be afraid to be wrong. So I found a safe place in being able to just ask questions, learn new things, contribute my thought, and say, hey, punch holes in this. And a lot of people don't speak up, but I have a big mouth, but I do it hopefully in a way that's like, I'm going to contribute what I think, even if it's from my gut, but hey, you got a better thought. I'm like always saying, hey, that's a great point of view. And then you get included because it's like, I'm not being a jerk, I don't think. I can get very passionate. I can get very, viewpoint opinionated about something and just say, but, help me. And so I just, issues came up. The DTI issue a couple of years ago, I actually got my team to do work, and I served that up to the MBA. And next thing you know, they're inviting me to a call with, Nawa and Director Thompson and Deborah Still and some other, Bill. I'm having a brain cramp right now because I'm getting old. But that was effective. Like, it felt like our message got through, and sure enough, we turned it over. So if you feel like you can influence, you get kind of fire in your belly. And that's about when that really started to pick up.
I love the fact that for you, it's an intersection of you have the knowledge, you have the understanding, you have the expertise, and the passion to share that as well. And that's the one challenge that most people we know in the industry, they might have a burn that they want to talk about it, and they're not confident in themselves or whatever to say, I want to be able to speak up and do this. And that's one thing I've loved about the MBA is how they do. I remember taking speaker training from MBA, Megan Sullivan years ago for advocacy, just, having your 3 points and talking to the legislator and always trying to come back for that. And similarly, I got the bug when I was local president in Ohio, MBA, CMB, the Columbus Mortgage Bankers Association, but love the fact that your passion comes out. And I always tell people, Deb is one of the smartest people I've ever met, is passionate about anything about this industry and doesn't forget about it. And I love that when you were talking about when you were running production in that, the products. I remember when I was originating and managing for First of America National City, we were checking accounts and mortgages. You wanted to take the core for the people because you could understand. And it was always used to be the joke when we were training people. If you get a check at application for their application fee check, and you'd say, well, it's a different bank. And say, I can't take it. It's not our bank. And they'd look at you like, what? And I'd say, well, let me introduce you to Barb or to Stephanie, one of our managers here. I got to at least, do that as us. But anyway, so apologize for that. But the Basel stuff, let's go back to this. I think, obviously, Basel's been around for a long time. It's re-emerged based on the fact that, Basel, after the great financial crisis, pushed banks away from being very engaged in the mortgage world and trying to do more things. And it's because of those that the IMB stepped up and filled the void and have really grown the production through those opportunities. But, it's one of the things that, this is Basel III that we're talking about, because Basel I was after stock crisis and other things across the world. And that was in late 80s, early 90s.
Mm-hmm. Yep. And then, Basel II, and then Basel III, and now Basel III Endgame and reproposal. So it's been iterative. What's interesting about Basel, the political, I feel like this is our one opportunity because of the convergence or confluence of the political landscape and affordability being a constituent hot button, and that we've been more than 10 years post-crisis solidly and survived COVID really well.
Yep.
So stability in the marketplace is there. There is systemic risk with perhaps, I don't want to say too many IMBs, but I think we do need to bring banks back for some counter-cyclicality that they can bring to the ecosystem. This is not a competitive play. There's room to maybe rebalance a little bit, but take that out of the equation and look at the actual risk of MSRs, which is the number one issue on that 250 risk weight. We've actually looked at it, and probably by itself, it is a high risk weight because it's a level 3 asset, which means it's less liquid, more volatile, et cetera. But the more we bring banks in, the more liquid that market will be. A junk bond is not as heavily risk weighted. Think about that. Your UMBS, which is the other, the main lion's share of the interest rate strip, is 20% risk weight once that UMBS is formed. But 250, when you look at the loan by itself in the MSR strip, is not terribly far off the mark. So we can't just go out into the industry and say it's 100% without data. Well, if you hedge it, and let's talk about hedging. If you hedge it, the data does show you that it should be a lot lower. Let's say 100, maybe plus a little or minus a little. You could argue even lower. So we have to advocate with data, which is why I think they asked it as a question. So right now, like lots of calls with lots of trades are trying to finalize their letters. And I think we have one last opportunity to get away from 250. But we do have to think about the ecosystem. We have to think about the small banks. And some of them, don't have to use the risk weight. I also think the definition of hedging doesn't mean you have to use instruments. You could have natural hedge, and your supervisory agency can tell you if you're effective, because maybe MSRs are not a large part of your risk of your whole bank. So I think these are the last minute things the industry is kind of chewing on, like how to articulate this to influence that. Otherwise, I think we'll never see less than 250.
And Rick, you may not, or maybe you do, the last proposal, the previous proposal for Basel III under the last administration would have made a lot of banks support for the mortgage, not beyond what we're talking about here, but even like high loan to value loans, higher DTI loans, warehouse lending would have negatively penalized those as well. And it made it harder for banks to participate in those parts of the market. And certainly we know IMBs don't exist without a place to get their working capital and warehouse lending.
Yeah, no, that's, well, it is. And that's where I think the advocacy piece is so important. I think we had talked about this, Bob, in previous shows where I almost think that some of the largest producers in every state in the country should be showing up at the legislative day that the NBA does to be able to speak with Elizabeth Warren and other, very vocal leaders in the industry as they establish policies that indirectly and directly negatively impact either the consumer, either in the disclosure or process or the fluidity of mortgage origination, so that it's clean and it's easy to understand by the consumer, or whether or not they're indirectly negatively impacted because of esoteric kind of restrictions on various products, like you're talking about, or the underpinnings of whether or not a lender or a bank, for that matter, is going to offer certain products to the consumer, right? And they might indirectly, and they're not even aware sometimes that they might, certain policy changes negatively impact. I mean, high DTI loans affect veterans, affect a lot of low to moderate income borrowers, and if you pull the proverbial bank rug out from underneath the industry indirectly, then all of a sudden a big piece of the very consumers we're aiming to try to serve and to get into homes don't get into homes. Those options, get completely taken off the table, and they don't even know it. The legislators don't even know it.
They don't. You're so right, because think about what they have to know, and think about how much detail we just went into. And I just really learned a new aspect today. Like I told you, every time I talk, I learn. Every time I listen, I learn. And I had a new angle today, or a new concern to take into consideration for comprehensive impact, and how do you influence them? So this was the hedge piece I was just talking about with the MSR. Let's define hedge, because I was thinking, the instruments we use when we hedge, because we're at fair market value, but some are at low com and some are at this. Do you think a legislator is going to know all that? No, we have to figure out in advocacy how to simplify it and tie it back legitimately to affordability. And it's kind of like the LTVs that you're talking about that are going to come out of this, as it will be used in a lot of ways to make affordability and pricing better, but the bank's going to hopefully want to have some additional return from it too, instead of competing it all away. But at the end of the day, it's home ownership. So you could say, I'm going to compete it all the way. I'm going to get more volume. I mean, so that advocacy and pointing out those benefits, and also addressing that it's not just for the sake of lowering it, that the risk is calibrated correctly so that it's legitimate.
So do you think the privatization, the full decoupling, out of conservatorship of the GSEs is going to spawn dozens, potentially, theoretically, like I always wondered why there wasn't a GSE for non-QM. Like, why isn't, and that might be somewhat of an oxymoron, but it strikes me that there needs to be some outlet to be able to serve a very growing niche of consumers that, do have multiple sources of income, multiple jobs. They might have multiple, they might have a couple companies, small companies that they are collecting income, differently than your standard bread and butter, W-2, job. And it just seems like, there needs to be a much more expanded view of the GSEs beyond just the vanilla, conforming and non-conforming kind of, products, and then the underlying guarantees of those products.
Yeah, we have to think about this as national housing. Is that where the country wants to go, utility or what have you? Because when you talk about a government-sponsored enterprise, and even if they exit conservatorship and it's implicit or explicit guarantee, because Ginnie Mae is, AAA, fully backed by the government. Yeah. Right now, you could say in conservatorship, GSEs are fully backed by the government. If they exit, and this is why I think we have to have a careful exit from conservatorship if it ever happens, the government taxpayer, because you have to think about it being a taxpayer, to put a guarantee fee into, look, you have prime non-QM. We can't think non-QM like subprime like we did, pre-crisis. But they are higher yielding assets because they're a little bit higher risk. You know, how much do we put on the taxpayer to pay for that? I think you have a core conforming secondary market with a government guarantee. I think we need an explicit one when they get out of conservatorship. And then you have the private market. I almost see the conforming GSE market shrinking, and letting the private market have more. And the more they have, the more liquid and stable it'll be. Because right now it's like, you know, something happens and they shutter their doors and you don't have a jumbo market, right? COVID, June of 2020. And then it opens back up, you know, slowly. So I'm all for a robust private market, but we got to be careful what we ask for. But can you really GSE-ish everything? I don't think so. You know, I think they'd still compete. Like, if they go private, somebody else is going to compete with that GSE if they're doing non-QM. But that GSE non-QM guarantee fee, I think would be, you know, where does it land in comparison to the private market?
Yeah.
Maybe it's more competitive. So I'm not saying what you're saying is not an avenue. I think that's why we're all still trying to figure it out.
Guys, that's fascinating. You know, I mean, it's good that you're as involved as you are in more capital markets. I think capital markets leaders tend to be, you know, in the office without windows, in the back of a, you know, corporate headquarters. You know, they tend to be the zoo animals with no locks on their cages, you know, because you want to keep them, you got to keep them sort of, you know, tucked away.
Yeah, the quants with the slide rules in the air-conditioned computer room. Yeah, I get you.
Rick, I'll say one further.
Yeah, go ahead.
It's good for us that people like Deb are involved in as much of this in the advocacy side, in addition to what she's doing at Citizens.
Oh yeah, yeah. There's no question about it. When did you get your CMB, Deb? Were you an early adopter?
I got it in 2011, a lot longer than I planned on, but I kept putting it off. I had gotten all my points way before, but anyway, you know, better late than never.
Yeah, no, there's no question about it. I think, you know, what is so interesting is when the Today Show has, you know, wants a virologist and they want to, you know, they get an MD on the show to talk about, you know, in infectious diseases or whatever the case may be. You know, if you want to get, you know, obviously an electrician, they'd get a certified electrician on a show to talk about, you know, whatever the issue might be. It's so fascinating is that as instrumental, I mean, housing's what, 18% or so of the GDP. When you look at all the assorted industries that support housing, you know, maybe it's a little bit higher than that. It seems to me that newscasts and shows and radio shows should be highly aware of the CMB and industry professionals, because they end up turning to their local mortgage guy, right? Which is good. I mean, that's a step in the right direction. But just because I wired my outlet the other day doesn't mean I'm not going to burn my house down, because I'm not an electrician, you know. And it just seems to me that there needs to be much more aggressive, broader awareness, both in Congress, but also just disseminated into newsrooms on who to call for competent information about mortgage, housing, and real estate.
I agree. And this is where I think MBA and even our small nonprofit Capital W Collective is trying to focus on educating people more in, you know, kind of nuanced spaces, more complex spaces in a simplified but meaningful way, so that we're seeing more loan officers go to the advocacy, which is fantastic. They're the ones that are connected to the customer. They have a little more insight into compliance or capital markets, enough to be able to have a good conversation. In fact, on that level, because, you know, I'm not going to go down a rabbit hole in great detail with a congressman, he's going to shut out and think what he's having for dinner tonight. So I think that education and advocacy, when I talk about MBA's education, they're really trying to like Capital W is helping them write the School of Capital Markets, which is yet to be launched, but it's going to come out later this year. So
awesome.
It's to focus on delivering to an audience more like the loan officer or junior capital markets people than taking my head of trading and trying to teach him something he probably already knows.
Yeah.
That type of thing will permeate also kind of grassroots up to, the media calling the experts and so forth. But the more we can educate and teach, the better off. Because even it was interesting, there was a group that went to the Fed, and Bill Emerson and I spoke about the FSOC report that talked about, do we need a new regulator for the IMBs and intersect or be somewhere engaged with the IMBs in the States? And we're like, well, you don't need a new regulator, number one. And he talked about what we need to fix up front with the Ginnie Mae structure and bifurcation of servicing and all the things that I think are being worked on and probably have a strong likelihood to get fixed, going forward. There's very open-mindedness. But back to my point, at the Fed, Chairman Powell and the other governors were listening to us, and I said, you have a playbook already. And they thought I was going to talk about COVID. And I said, oh, no, I'm talking about the RTC. And I mean, it was funny. Like, we've done some things over and over to be able to tell our regulators, you don't have to start with a new regulator. This is how you solve this risk problem and keep your market stable. Back to your 15 or 18% of GDP, what can knowledge, what can advocacy, and what can experience that you can draw on to help influence and advise the uninformed, because it is so complex. So I didn't mean to go down that rabbit hole, but I think it's just fascinating. We all think that those in government know more, but really they're broader experts in most cases than deeper experts.
Yeah. What's hard about that is, and Bob, this was my first legislative conference that I got involved with. And when we met with various legislative staff members of members of the U.S. Senate and of the House of Representatives, a lot of these policy researchers don't own a home. They've never owned a home. They're young. They're smart. They're good policy, policy researchers from, Harvard or some local, elite school from Williams or Amherst College or something. But they've never, I just asked the simple question: when was the last time you were in a mortgage company? Just walk into a mortgage company, Yeah. Or let me, better yet, let me give you some suggestions of which mortgage companies to go into.
It's interesting because, and sorry to interrupt you, but you
right.
talk about them being younger and not owning a home yet, but those people end up being the regulator, the legislator, the whatever. I remember Matt Jones when he was working in the Senate. Now he's chief single family at HUD. I remember when we went and visited one of our senators, Rick Scott's office, and his chief of staff. We're talking about trigger leads, and it was, half paying attention, whatever. But as soon as Yvette Claremont, CMB from Florida, started giving the story about one of her borrowers being harassed, and she just looked up at us and said, "Wait a second, are you talking about when my husband and I were trying to buy our first house?" And immediately we started getting pinged during that application. They got 74 calls that day. And George Rogers, Senate Republican lobbyist for MBA. I remember when George was a staffer working in Ohio for Representative Boehner. So, I mean, they become people, and getting those opportunities. I love what Deb said and what you are putting together. I mean, the people who are doing it and working with the constituents, with the families, they're the people that make the best connections with legislators, because they really have that feedback of what it really means. And it's an opportunity to develop that relationship that maybe it doesn't mean something today, but in 5 years, 10 years, you never know when somebody's going to be, running HUD.
Yeah. Well, Deb, I really loved having you on the show. Thank you so much. And it was great to meet you. I feel badly. I've been in the business, 25 years, and I feel like it's my negligence that we haven't really spent much time together. But I really appreciate connecting with you, and I'm glad hopefully our faces will become familiar. So when we see each other at conferences, we can stop and say hello and chat. Because Bob is my institutional connector to people that are, that matter, that are a part of the, the governance of the industry,
Well, I thank you. And I have a question for you, Rick. Talk to me about your doctor title. Your doctor in what?
Yeah, it's in finance. So I did my dissertation on public and private partnerships, and a part of that was on the GSEs. Just because it was it's kind of a unique, like quasi, relationship where, there are clearly stated public goals around, home ownership. And it's a way that the federal government can partner with private industry to implement and sort of roll out, these goals to achieve, higher rates of home ownership. But those are very intentional. Like there's a real cause and effect. Like we just talked earlier about how some liquidity changes for banks can shut down mortgage lending like that, right, or really curtail it really fast, and so legislators will do that. And then they'll say, why aren't you guys lending to the low moderate income, groups? It's like, well, we want to, but our hands are tied, or you're making it really hard, or you're not making it as profitable in light of the risk that we're assuming. And so it's, but yeah, so that was where my research, I always wanted to, teach in college and that sort of thing. But as you know, the mortgage industry is hard to, it's hard to quit, to be honest with you.
It is.
I wanted to go into higher ed administration, but it doesn't pay as well. And mortgages are, once you kind of know what it's hard to, it's hard to get out of it, but I do like the MBA's program now. I've taught at LSU and I taught at Cleveland State. I participated in that program that Deborah is doing. It's such a good program, man. I love dealing with the kids and these young men and women who are just so hungry to understand like the world around them and what's going on. And they're so smart, but yet they know so little about credit cards and debt and mortgage lending. And so yeah.
Well, thank you for your service. And I think it takes a village. We can all keep learning and teaching. Young, newer people can teach us with new probing questions and keep us fresh. Like I think about questions. Oh, I used to know that. I don't know it now, or I forgot it. So, there's just always a mutual net benefit for everybody involved. So thanks again for having me.
Yeah, thank you so much.
Thank you so much. Really appreciate you spending the time. And I will encourage folks, if you do see Deb at a conference or something or hear her speak, go up and meet her afterwards. She'd love to talk to you. She's great influence and, great leader in our industry. So really appreciate
Thank you. And Rick, I'll give you a hug next time I see you. How about that?
Oh, that'd be great. I love it.
Okay.
Thank you so much.
Y'all have a good one.